Everyone, thank you for joining us today. My name is Chris Urbanski. I'm the Vice President, Business Development at Hahn Investment Stewards. So once again, thank you for taking the time. We have a great presentation planned for you today, very informative. And with that, I would like to introduce our special guest and keynote speaker, Jean-Pierre Laporte. Jean-Pierre, welcome and thank you for being here.
Thank you very much.
Great. So Jean-Pierre is going to introduce a new solution for you. Just to give you a quick background on Jean-Pierre, Jean-Pierre has brought his passion and his expertise as a pension lawyer to provide a better solution for incorporated individuals looking to save more for retirement while minimizing income tax. JP has worked for a number of prestigious Bay Street law firms in Toronto and worked closely with large public pension plans such as HOOP, Ontario Teachers, OMERS, and Ontario Hydro. He brings this tremendous expertise to bear on developing new and innovative solutions for Canadians. JP has dedicated himself to improving Canadian pension legislation, and he is often called as an expert witness before the House of Commons Standing Committee on Finance in Ottawa to assist our lawmakers. So once again, JP, thank you for being here with us. Just looking quickly at our agenda. So for those of you that are not familiar with Hahn, I will actually give you a quick overview of what we do and how we do it. Then I will pass the floor to JP, and JP will introduce the Integris Personal Pension Plan. And after that, we'll leave 20 minutes for questions. So please, on your screen, you can type in your question if you have anything. And so I don't forget, we will have the presentation available, and we are also recording the presentation, and we will provide you a link as well. So moving on, why are we here today? Well, as you know, and you're in the trenches, I don't have to tell you, our industry is changing. There's a number of changes coming up soon. For example, CRM2, obviously administration, compliance, all these things create workload for us. But we believe that the biggest issue right now is competition, and the fact that it's getting even more difficult these days for new business development, even with, Facebook, LinkedIn, social media. Clients are more aware of what's going on and are becoming more sophisticated with all the information that's available out there. So the reason why we're having this presentation, we believe that at Hahn, that a solution like Jean-Pierre is going to introduce to you is an ideal solution for your high net worth clients. And in fact, throughout my travels through Canada, talking to financial advisors, I always ask financial advisors, what kind of a target client are you looking at? And most tell me that, it's $250,000 to $1 million in investable assets. Well, the problem is that most of those clients with those assets already have advisors. So what kind of products do you have? What kind of solutions do you have to look different to actually make yourself appealing for that client? So moving on, I'm not going to go over this slide in detail. Just a couple points, quick overview on Hahn Investments. Client asset stewardship is our #1 goal. This is not a sales gimmick in our firm. It's in our culture, and we take this very seriously. So capital preservation is the main target of our portfolio strategy. And that being said, in obviously the financial crisis of 2008, we have 11 portfolios. On average, our portfolios were down -5, and I think everybody knows how much the indices around the world, how negative they were. And in fact, some of our portfolios made money. We use a global macro approach, which is, we believe, unique, and we're not product makers, we're investment managers. That's what we do. So quickly looking at some of the leaders of our firm, Wilfred Hahn, he's the chairman, founder, and co-CIO. He's the former head of Royal Bank Global Investment Group. Mark Arthur, who's our CEO, he was the vice president, investments, and director of Royal Mutual Fund. So essentially, the top two guys in our firm were the #1 and 2 guys at the largest Schedule I bank in Canada. Tyler Morty has been with the firm since the beginning. He's considered one of the experts in Canada and, in fact, in the world on ETFs. He was named as one of the top 10 rising stars by Index Universe, and you've probably seen him in the media, on BNN or other media outlets. So you're in good hands. We have a really strong team behind this company. So what makes our company different? So some of the key factors, I'm not going to go into this in detail, but once again, we use a global macro asset mix strategy to portfolio management. We believe that a static 60-40 approach to portfolio management is inefficient. A tactical asset approach where we have more flexibility is, we believe, the right approach for the changing environment and the current market condition. We use an opportunity investments, which means that not only do we utilize fixed income equities, but products that are not correlated to the market, and we only utilize exchange-traded funds, and that we've been doing for the last 11 years now, since 2003. So everybody talks about adding value for clients. Well, what's our added value for advisors? Product value. Once again, we have 11 different portfolios and consistent benchmark beating performance since 2003. Service value. We offer a number of different tools available to the advisor to help with business development. Personnel value. Essentially, we have 3 different teams. My team, which is the business development team, we're here to help you with any type of marketing, client meetings. We have the admin team. We have a dedicated admin team in Winnipeg, which is essentially back office. And obviously, we have the investment management team, which is very accessible. And that's a unique part of our business as well. Our managers are accessible, and your clients know who the manager is. And image value. Once again, longest track record in the world doing what we do, and strong leadership as well. So moving on, let's take a look at some of the key client benefits. First and foremost, access to discretionary portfolio management. As you know, in the past, you needed excess of $1 million to get into the space. Our minimums are $100,000. So now you can go to your client saying, I can take you to the same level as you pension at work with only $100,000. Separately managed account structure. For those of you that are not familiar, we do have a piece that explains this structure, but essentially there's a number of benefits in this structure versus pool structure. Some of them are individual cost base. You can deduct the fee, full transparency, and so on. We have comprehensive portfolio reporting, and we have access to some of the world-leading ETFs. So now our approach is a client-centric approach. First and foremost, it's a financial professional. This is your client, and you're the relationship. You can do financial planning and so forth. Next is the portfolio management team. As I said, we use a tactical asset strategy. This full communication to you and your client. Then we have our dedicated back office. Essentially, we always say, this is your back office. We offload the bulk of your admin work. The money sits at a custodian, National Bank or Fidelity Canada. And finally, you have our team, the business development team, to assist you in any way. So once again, why are we here? Well, when we spoke first to JP and JP introduced the personal pension plan, we felt that this is a great product, and we believe that this is added value that we can offer to you as an advisor to show you that there's new and innovative solutions that can help you with your business. And finally, our portfolios fit the criteria that's necessary for a product like this. So this is why we're here. And with that, JP, please take it away with your presentation. And once again, thank you for being here.
Thank you very much, Chris. So the Integris Personal Pension Plan, I wanted to start with why personal pension plans now. And the main reason here is that we know that the conventional IPP that's been around since 1991 is complex and lacks flexibility and cannot adapt to the cash flow needs of business people. But now, a couple of factors have conspired to make this a lot more appealing. The first one is that since January of 2014, the taxation of non-eligible dividends for private companies has gone up. And the arbitrage opportunity that used to be there for keeping the money in your corporation instead of putting it into salaries and RRSPs or pensions is shrinking, and in most provinces it's the other way now. You're better off with a little bit of salary rather than dividends. The other thing that Integris has been able to achieve is to introduce a system that is simple, turnkey, with economies of scale and flexibility, which are all problems that or I guess solutions to a problem that the IPP had. So that's why this is the time to seriously consider the personal pension plan. What are some of the key benefits? Well, the first one, of course, being that because it's relying on pension rules instead of RRSP rules, there's the ability to stash away an extra $1 million of registered assets above and beyond what the RRSPs can provide. And that's as a result of a number of factors which we'll get into later on. But the bottom line is that every single day that your client refuses or doesn't upgrade from their RRSP into a PPP, assuming that they qualify, they've just lost $136. And that's money that they cannot make back. The other big benefit of the PPP is it provides the best creditor protection around, much better than RRSPs, and we have a slide on that later on. There are a number of new or additional tax deductions that are simply not available in the RRSP context that we'll get into. Integris is also providing fiduciary turnkey and simplified pension administration. So the compliance burden that used to fall on the shoulders of an IPP sponsor, meaning your client's corporation, is now taken care of by Integris. And the beauty of this is that we don't touch the money. We don't manage it. We don't custody it. It's really the advisor, i.e. yourselves, who continue to be the money manager using Han and others in order to manage the money for your client's PPP. So it's the best of both worlds. So what's some of the immediate value drivers for yourselves? It's a great way to prospect high net worth business owners, therefore leading to an increase in the book of business without adding any risk. And we'll get into why the PPP doesn't add any additional risk. If anything, it reduces risk. And it offers you an opportunity to enhance your client relationship by having offered something that's much better than traditional RRSP or even a conventional IPP. So who's the perfect candidate for this? Well, they have to be incorporated. So there has to be T4 income paid from a small, incorporated business to the members. So we're thinking here a doctor, dentist, lawyer, accountant, the list goes on of all the professions that now have the right to incorporate. Plus your entrepreneurs and your small business owners, your franchise owners, your McDonald's, your Tim Hortons owners, they're all candidates. And they typically, they can be any age, but we'd like to think that starting around age 30, it's starting to make a lot of sense. So you can see that it's quite a large pool of people that would benefit from this. We thought that we would provide some case studies to show you the power of the PPP. And we picked two kind of extreme examples. Client A is your 35-year-old that's got a small business. They're only pulling $80,000 a year. They're starting out in life. They've got other expenses, so they've only been able to stash away $50,000 in RRSP. They've been earning 5%. They've been very conservative, or maybe they haven't had the proper advisor to help them boost those returns, and they plan to retire at 65. And then the other is a more mature client that's got a more established business and decides to withdraw the maximum pensionable income of $140,000. They've already got $400,000 as saved. They're also in the same market environment, and they also return at 65. So if you look at the math, after 30 years, client A, if they had stayed in their current RRSP with that rate of return, they would have about $1.5 million accumulated. However, if they had upgraded to the PPP, they would have $3.5 million. So if you deduct our fees, the net to the client is close to $2 million. And client B, the savings horizon is much shorter. It's just 10 years. Their RRSP will have ballooned to $949 and their PPP 1.2. So again, deducting your fees, you've just created $305,000 of extra value that wasn't there without taking any additional risks in terms of the portfolio construction. Now, what if client A decided that they wanted to buy back some years of past service? In this case, they haven't been in business for very long, 2 years, so they decide to purchase 2 years of past service based on the income that we had set out before. The cost for 2 years is $45,000. Now, $27,000 of that would be a transfer from their RRSPs, so there's no net new assets for you to manage because you're already managing their RRSPs. But there's a new $18,000 corporate contribution that would increase the assets under management. Plus, it's tax deductible to the corporation. So they'll get a tax refund based on their corporate tax rate of, depending on the business. In Ontario, typically would be around 15.5%. So you get fresh money coming into the system. Plus, the client now has purchased 2 years of past service. Client B, they've had their business for a little bit longer, and their salary is higher, therefore the cost is much higher for 10 years. Again, a chunk of that has to be satisfied through an RSP qualifying transfer, but their company is able to cut a check for 90 grand, claim a deduction for that, and now you have an extra 90 grand of assets under management. So a lot of people ask us, well, you know, how are you different from IPPs that have been around since 1991? So we'd like to show the Coles notes of some of the key features that we provide that isn't available in the market right now. The first benefit is really the fact that we can exceed the RSP limit. And while IPPs and the PPP can offer that, the problem with the IPP is that if you're younger than 40, you cannot exceed the RSP limit. If anything, you'll be restricted as to how much money you can contribute each year, and it would be below the RRSP limit. So it segments the market and only allows you to look at people that are 40 years old or older. Whereas with us, and we have a slide on this later, you'll see that it doesn't matter how old you are, you're always above the RRSP limit. We have a combination pension plan. So the registered pension plan has two components: defined benefit, which is IPP, and defined contribution, which is like an RRSP. On top of that, we have a third account, which is called the additional voluntary contribution sub-account, or in pension parlance, we call it AVCs. And that's a place where you can put in existing RRSPs that you have, roll them in on a tax-free basis. The conventional IPP doesn't have this flexible contribution structure, and of course the RRSP is just an RRSP. We also, I'm going to skip over number 3 because it's common to both IPPs and PPPs, but a lot of companies are not even aware that since July of 2010, you can claim an HST credit refund if you are a pension plan administrator. So that's why we put a question mark for the conventional IPP. The other thing, too, that's really key to Integris is the fact that we provide a full turnkey, fiduciarily managed compliance system that really takes all of the administrative headaches off of the shoulders of your client and rests them on our shoulders. Some of the key innovations of Integris are, of course, superior plan design, this ability to have both a defined benefit and a defined contribution components with the ABC overlay. Fiduciary oversight, I've already mentioned, this turnkey system, and we have some slides on that coming up. And pricing. Because each of our plan texts is cookie cutter, we are able to generate some economies of scale and therefore lower our cost to the client and provide more value at a competitive price to your clients. So let's drill a little bit into the details here. In terms of the contribution options, we have, as I said, both the DB, or defined benefit, and the defined contribution component. If you are in the defined benefit component, it's because your client has a lot of cash and they want to tax shelter as much as possible. The contributions are actuarially driven. You'll see that as you get older, more contributions are required. However, in a normal IPP, if you were young, like what I define young is 18 to 39, the tax rules are such that you would be penalized vis-a-vis an RSP. You wouldn't be allowed to put as much money into the plan. So we fixed that by providing the combination structure, and this slide illustrates the tax limits depending on plan type for 2014. So RSP 24,270. Doesn't matter if you make $1 million a year. That's the maximum that you can put in. The defined contribution or money purchase limit is slightly higher, $660 higher this year, so that's why there's a small gap. And then, of course, the defined benefit or IPP limit is actuarially driven. That's why at the bottom we have the age. As you get older, the actuary allows you to put more money in, and of course, whatever the actuary deems necessary for the plan is tax deductible. So a young person could start off on the defined contribution component of the plan and always exceed the RSP limit, and then when they hit the magical age, they can elect to go into the DB component and turn on the turbo. So how would that work in practice? Here we have an example of someone who in year one starts off with the defined benefit component. And I put DB first because they might want to do a buyback of past service, and you need to be in the defined benefit component in order to do that. And then for whatever reason, in years 2 and 3, and I put 9 as an example, the business needs cash and the owner doesn't want to put into the pension plan. So what they can do is elect to move into the DC component of the plan. And under the DC component of the plan, the mandatory company contribution is only 1% of salary. So you can see a dramatic drop in the cost. And then for whatever reason, years 4 to 8, they decide to go back into DB. Maybe business is thriving, lots of cash. And you'll see that the bars are going up. That reflects the previous chart that showed the green line going up. And the solution, of course, is if the client wants to fully fund all years, they can do a buyback of past service whenever they have money. The actuaries called in will calculate what the cost would have been, and you can do your qualifying transfer and your corporate contribution. So you end up with a fully funded defined benefit plan for all years of service, but the client decided when the money was going to go in. So that's that really creates 2 escape hatches for the client. The first one is this ability to switch into the DC component. I've already mentioned that it only requires a 1% contribution. The second escape hatch in Ontario is provided by Regulation 48, and that's for owners who own 10% or more of the voting shares of their company. They can also elect to reduce the accrued benefits in their plan, to amend their plan and reduce the pension payable, and that allows you to get rid of any deficits that might have been accumulating in your plan. So there are 2 ways of avoiding putting a noose around your client's neck. The other aspect that I thought is interesting is if you are under the defined contribution option, the 1% is mandatory, but there's also an option to do voluntary employee contributions, which range from 0 to 17% of salary, and those get saved into the third account, the ABC account. The beauty of the ABC account is that it's voluntary, so it's not locked in by pension laws. You can also transfer your existing RRSP in it tax-free with the T2033. It's flexible, and all of the MERs and IMFs that you were not allowed to deduct while you were inside of an RRSP because of the Income Tax Act now become tax deductible for your corporate client. So it's a way of further reducing the cost and at the same time creditor protecting your assets because they're now pension monies. Some of the additional tax deductions of the PPP are the ability to deduct the fees, not only the investment management fees, but also the Integris fees, the HST credit that I briefly mentioned, the special payments, which is what happens when you're under the defined benefit component of the plan and the assets don't return 7.5%. What happens then is that the actuary will declare that there's an actuarial deficit in your plan, and the company gets the opportunity to make additional tax-deductible contributions to bring the asset level back in line with the liabilities. So it's a great way of tax sheltering even more money. And then there's the buyback and terminal funding. So buyback, I think most people are familiar with. Terminal funding is the ability to enhance your benefits at retirement, which there's a cost attached to it, and that cost is also tax deductible to the company. So a whole bunch of additional tax deductions which you don't find in the RSP world. Robust credit protection is important for a lot of businesses that are in more risky industries. A lot of people think, and that includes colleagues of mine that are lawyers, that RSPs are always protected. In all of these jurisdictions, they're not prior to bankruptcy. After bankruptcy, there is some protection, but unfortunately, it's limited to the 12 to contributions that were made prior to the 12 months up to the bankruptcy event. In a pension plan, pension rules kick in and you got protection at any time. Now let's look a little bit about the fiduciary oversight. Very important. We provide the highest standard of care under the law, which is the fiduciary standard, and that's a result of the Pension Benefits Act. We provide economy of scale, and we take care of all the compliance burden. And we do it through proprietary software, including distributor portals that are secured and which house all of the FAQs, the PowerPoint presentations, and our proprietary tools to determine whether or not someone is optimizing by moving up to a PPP. We also develop an online enrollment tool which allows you to just key in information that the client needs to provide in order to have all their legal documents set up. And we take care of the plan documentation, the actual valuations, the registration with the regulators. And finally, all of that stuff gets fed into a secure private client portal, which is really a dashboard that gives you access to everything the client needs to know about their plan, scanned and readily available 24/7. Here's some snapshots of some of the tools that we've developed. The distributor portal on the left. On the right, we have the Wealth Optimizer, which gives you the year-by-year comparison and shows you how much extra money the client is missing out on. The individual client portal, which on the left-hand side has scanned versions of all the documents they've signed, and on the right, access to the investment platform and the communication log, which is all transactions with our pension officers, which are the relationship managers who answer questions that people might have about their pension plan. So the online enrollment tool is, again, just an online questionnaire which then generates the PDFs of all the legal forms that are required in order to set up a plan. So that's a great way of minimizing the paperwork and ensuring that information is keyed in properly. Just a brief slide on our team. I wanted to direct people's attention to a couple of people. Our Chief Information Officer is Richard Kahn, who oversees our IT development team that does our proprietary software. Richard also consults to some of the largest banks in the country with their security software. So we get to be at the same level as some of those Schedule I banks. We have our Chief Strategy Officer is Gavin Graham, who used to, you might see him on BNN, he used to run the money for Director of Investments for BMO Asset Management. So he oversaw about $50 billion in assets for the bank. We have our own actuarial department, and the 4 pension officers listed under CCO are the ones that have over combined 100 years of pension law expertise that's available to you and your clients. They're supervised by our Chief Compliance Officer, who used to look after the IPPs at BMO Nesbitt Burns. So a tight, highly qualified team to provide the support. In terms of fees, we're getting to the end of the formal remarks. We have 2 options. One is fee for service, which is a standard way in which IPP providers get compensated. So in the first year, there's a $2,500 fee, and then it drops to $1,800. That's the sort of base pricing. We can discount that if advisors decide to send us a bunch of people at once, so we can do group discounts. And then the other option, of course, is we also offer an asset under administration method where it would be 50 beeps or 0.5%, but it's capped at $500,000 in assets. So that's for very small accounts where people do not want to pay the fixed fee, where the math works out that it would be better if they just paid a small percentage of assets under management. So that's all for the formal element of the presentation, but thank you for your attention, and I'm going to pass the baton back to Chris, and I guess we'll have questions.
Great, thank you. Just before we get into questions, I just want some clarification in regards to fees. So with these fees, and let's look at the ones as assets under management. In this case, the client would pay the 50 beeps, then the advisor would collect an average, say, 1%, and then there will be a fee for the portfolio manager. And in our case, for example, would be 0.8. So all in, you're looking at 2.3%.
Yeah.
So based on that, for a service like this, it's very competitive, as everybody can see. Now, so JP, thank you very much. As mentioned before, we will have this available, this presentation for you. If you have any questions, please feel free to contact JP directly or visit their website. You can always call us as well here at HAN, and we will direct you to the team at Integris. If you have any questions on HAN directly, you can call anybody here. More specifically, Aaron Azad, who's the business development, so is Dan Miller, and obviously myself, Chris Urbanski. So now let's open it up for questions, see if there's any questions at the moment. So once again, if there's questions, please enter them in the questions box, and I will read them out. Okay, so at this stage, there are no questions. Is there anything else that you want to add, JP?
Well, there's tons of things I could talk about. I mean, the beauty of the PPP is that it's very flexible and adaptable in the sense that you might have opportunities, for example, to go to a number of franchise owners that you might be dealing with on an individual basis and say, why don't we offer a franchise opportunity to your group of franchisees so everybody would benefit from economies of scale. So that's one potential opportunity. Chris?
Yeah, okay, so we do have a question here, and the question is, just so everybody knows it, JP, are there any limitations on the type of investments in the Integris PPP?
Okay, so thanks for that great question. PPP assets are, just like IPP assets, are governed by the federal investment rules in Ontario. And so the limitations are more concentration limits and related party transactions, not so much what type of investment you want to get into. So one of the things that a pension plan can do that an RRSP cannot is, for example, control a private company. In the context of an RRSP, if you own more than 10%, you hit up against the prohibited investment rules, whereas in a PPP, you can own the entire private company. So there's more flexibility as to the type of asset classes, and the rules that govern teachers and OMERS and the HOOP and all the big plans are the exact same rules that govern PPPs. So the answer is the limitations are not so much what you can invest in, it's more how much of the portfolio can you put in any one security, and who is, if there's a relation, like if you're, for example, you can't buy the shares of your own company because that's a related party transaction, and that's prohibited unless you fall under one of the exceptions.
Okay, thank you, JP. The next question is existing IPP to PPP transfer. So is that a possibility?
It is a possibility, and luckily it's actually a very easy transition because the IPP has already got a registration, and all you need to do is have a plan resolution, a board resolution amending the terms of the existing IPP and substituting in the plan text of Integris, the PPP, and now you can benefit from the PPP rules, and without having to go through a lot of additional hoops.
Great, thank you. Next question is, to what age does the PPP go to? When does it have to be sold? When does it have to be sold?
Well, it's the typical pension rules, so you can accrue inside of your pension plan up to age 71. And at age 71, you have to start taking a pension or doing something with it.
Perfect, thank you. Next question is, would my MFDA dealer need to have a contract with Integris?
We don't. We are flexible in the sense that if your MFDA dealer currently supports IPPs, assuming that the custodian that you use would allow the triple account structure, then there's no formal documentation required in order to start offering this.
Perfect. Next question is this available for someone holding a life insurance license only?
We do have a insurance platform through Industrial Alliance. So someone who's life license only could direct clients into this product at IA and get compensated.
Thank you. Next question is, JP, in the comparison of RRSP and Integris plan, you indicated on the slide that at the same level of contribution, the Integris plan would have a lot more assets at the end. Where does this additional return come from at the same level of contributions?
I think it's, and I apologize for the wording, what it means is that if you're at the top contribution, meaning that you're the maximum that's allowed for an RRSP or a PPP, you can accumulate a lot more money within a PPP than an RRSP. So, and the general rule of thumb is that about 80% of the total value comes from the interest component and 20% comes from additional contributions. So that's the general rule of thumb over 20 years.
Great. Just one more question on licensing. So what is the licensing requirement for providing PPPs? I know you answered that, but if you want to just do a quick overview. So essentially there's no licensing requirement. If you're insurance licensed, you can do it through an insurance, and if you're MFDA,
that's correct.
Yeah. Okay, next question is, JP, are there survivor benefits available under the Integris plan? If so, what are the survivor benefits?
Yeah, so the general pension rules kick in. So if you're thinking of the teacher's pension plan, the rule of thumb is that if there's a spouse in the picture, upon the death of the plan member, the spouse gets a joint and survivor pension, typically about 66% of what the pension amount used to be. If there is no spouse, then there are designated beneficiaries who get the money. If there are no designated beneficiaries on record, then the money is paid to the estate.
Perfect. Thank you very much, JP. It looks like those are the final questions. So if there's anything else to add from your end, JP?
No, thank you very much for this opportunity to introduce the PPP to your brokers and your advisors.
Great. So I'm sorry, there's one more question here. No, I'm sorry, there's no more questions. We just had some technical difficulties. So once again, thank you everyone for joining us. We believe that this is a great product for you to go to your high net worth individuals, something that in this environment may benefit your business. And if you have any questions, once again, you can contact JP and Integris directly, and you can always call us here at HAN, and we will direct your questions to JP's team. So